Rob Subbaraman, Chief Economist for Non-Japan Asia at Nomura International, for his thoughts. And going into 2012 as well. Okay, Rob, good to see you once again. Now, I should remind our viewers that Nomura was ranked #1, at least by, I think, Institutional Investor in the latest polls for your China research. So what about the markets right now? What are they saying to you?
I think they're nervous, and I think for Asian markets, it's clearly Europe that we're concerned about. I mean, our forecast for next year is quite a slowdown in growth, from 7.5 this year to 6.6% GDP growth next year. I think, you know, for Europe, things are going to get worse before they get better. We're starting to see Asian exports slowing down. And, you know, the real risk is non-linear effects kick in. And
non-linear?
Non-linear economic effects. Well, one is the export downturn deepens. Firms have to cut back capex and jobs, so it hurts domestic demand. And as Chairman Bernanke calls them, financial decelerator effects. So markets tumble further, wealth, confidence effects get worse, capital outflows from Asia. They're all things that can start to get non-linear, and that would lead to bigger downturns, particularly Hong Kong, Singapore, Taiwan, Malaysia.
Yeah, and what about the conference board? We heard about their warning on China as well. You're expecting a V-shaped recovery, though. Things are not going to look that great. Maybe, what, in the first 3 or 4 months of the year? They'll come back quickly.
Yeah, so we're I think, below consensus for the first half. We've got growth in China slowing to 7.5%. And I think an important thing to realise for the rest of Asia is the China slowdown this time is more domestic-led. It's housing. So the slowdown in China will hurt the rest of Asia more than last time. But second half of the year, and I would say we call it the yo-yo, the Asia yo-yo for Asia growth next year, because it will slow the first half, but it will come back the second half. Commodity prices will be lower. China and the rest of Asia will loosen policy.
Yeah, let's talk about policy, because there are a lot of discussions going on brokerage desks right now, talking about a triple-R cut. It seems imminent in China. Do you think that's true? Are we going to get one this weekend, maybe before year's out?
We could get a Christmas present. We could get one before the end of the year. It's certainly possible. We're not ruling it out. But all up for next year, we have 200 basis points of RRR cuts.
Right.
So we have...
So it's like four, basically.
Four more. And we have one interest rate cut in the first quarter. But the message we're giving is at this stage, we don't think Chinese policy is going to be eased nearly as much as it was in late 2008, 2009. We think there's some good reasons for them to be more cautious this time.
So the yo-yo effect for China. And in fact, China coupling with India still remain the growth outperformers in your view, despite the fact that we keep talking about the problems over in India with the weak rupee, industrial production falling for the first time in 28 months or so. But these two are still the big growth engines of the world.
That's right. I'll give you an interesting statistic. Based on our forecast for next year, India and China together are going to make up 60% of global growth.
60% of growth. What about the rest of the world? I mean, how can that be possible? I mean, isn't it Brazil, LatAm, and
well, probably it's a big chunk, a big part of GDP in the global economy is the euro area, and we think that's going to be actually falling by 1%.
Okay, so you're predicting a recession, basically, on the European side?
Yes.
Okay. So, Rob, before we left off for commercial break, we're talking about how Nomura is basically expecting a recession in Europe. What does that mean for the U.S., and what does that mean for here in the Asia-Pacific as well?
So for the U.S., we think at this stage it's going to be different to 2008, 2009. We actually have euro area GDP minus 1% next year. For the US and Japan, we have both growing at 2.3, about 2.25%.
Which PIMCO says is stall speed still. It's not enough
It's just enough to bring the unemployment rate down very slowly, very gradually. But, you know, our view for the US is that there is going to be quantitative easing in the first quarter. We think a lot of the fiscal tightening that's slated is going to be delayed, pushed out. And there's a lot of pent-up demand that we see coming through in the US. So it's interesting for Asia. For Asia, if you look at the G3, so US, Japan, Euro area, in 2009, the G3 GDP fell 4%, more than 4%.
Which is significant.
It's substantial. And Asia got hit very hard. You saw Asian exports literally fell off a cliff. For 2012, we have G3 GDP actually growing plus 1%. And it's because US and Japan, the growth there offsets the EU. We've still, however, decided to lower our growth forecast a bit because of China. the slowdown in China is more domestic-led this time.
Right.
And Asia's become more and more linked to China.
You sound so pessimistic on China today, Rob.
Well, in the next 6 months, we think the housing market is going to weaken further, yeah.
What about this talk about banking crisis? You know, 61% of respondents in our global investor survey say there's going to be one in China in the next 5 years. Are you that bearish?
Not for next year in terms of banking crisis.
In 5 years. I said in 5 years there will be a banking crisis.
In 5 years, I think it depends how policy pans out. So our biggest concern for China would be that things unravel a lot more than we expect. So GDP growth falls below 7%, maybe because of Europe.
Right.
China has to do another repeat of 2008-09 big fiscal stimulus. The credit and investment ratios to GDP get a lot higher. And then you're setting yourself up for bigger imbalances and the risk of a crisis after the new generation of leaders get in 2013. So our concerns would be if policies are too loose in the next year, leading to worse quality growth, but better quality, and then the new leadership gets in, and then 2013, 2014, that's going to be the trying time if that were to happen.
Wow, so you think that, you know, loans turn sour in just 12 months' time, really? Because some are saying that this banking crisis is based on sour loans, well, that'll take at least 5 years. You're saying it's going to, you know, basically the banking crisis, or not a banking crisis, but the assets go downwards in just 12 months' time. That seems kind of unbelievable, don't you think?
Well, we're not. Let's be clear. That's not our base case, right? You asked me how there could be a banking crisis, and I said if growth were to weaken very sharply in the near term in China, they'd have to again loosen policies a lot, and we would be confident that they'd do that.
Right.
Then you're raising the risk of a banking crisis.
But you're saying that so you're agreeing with that or disagreeing with that? So that's
not our. So what I'm saying is that's not our base case.
Okay.
Our base case is that growth isn't going to slow that much. We think it will slow to 7.5%, and they won't have to do another 08-09 big fiscal easing or monetary easing. It's only going to be moderate.
We're going to talk about China first of all, because there are risks here, inherent risks. I mean, everybody's saying, oh, we're going to manage a soft landing, etc., etc. But, you know, what would constitute a hard landing?
Well, there's so many different definitions out there. I mean, ours, we've tried to be quite precise. We're saying GDP growth slowing to 5% or less for 4 straight quarters.
Right.
So it's got to average 5% for 4 straight quarters or less than that. That would constitute a hard landing in our view.
But the chances of that happening, nobody's saying that that's going to happen, really.
Well, I think next year it's pretty low odds. The risk we would see, to our view, and we have, our base case is 8.5% growth, which I think is very consensus for the next 3 years. But the risk we would put to that, of our definition of hard landing happening, is actually 1 in 3. Starting to happen before the end of 2014, this hard landing.
What is going to drive the economy down in particular? I mean, that's what we're looking at here as well.
Well, I think one risk we see is China's economy slows too abruptly in the near term, so they have to ease policy a lot more, like 08-09, akin to 08-09. We already have very big imbalances. The investment GDP ratio is nearly 50%. Credit to GDP, if you include the shadow banking, is 175% of GDP. So these things could get worse. And then you're setting yourself up for the risk of a big setback 2013, 2014. So the risk, I would say, is too much easing near term, and it worsens the quality of growth. And then the new generation of leaders are going to have a much tougher time trying to deal with that.
I talked to the chief China economist at Nomura earlier this week, and he was said they're the most negative on China out of any brokerage.
Yeah, and we feel quite comfortable with that.
And he reckons below 8% next year growth.
We're forecasting 7.9 for the full year. We think it's going to get down to around 7.5 in Q1, Q2 next year. We are quite worried about housing. And don't forget, housing, you know, it's now making up 13% of GDP. And it has a lot of flow-on effects to the steel sector, the cement sector, even to consumption if house prices come off. The wealth effects.
Talking about banks who are also not that bullish on China, you know, Goldman Sachs is pretty much saying that they are going to not invest in, be very cautious about investing in specific IPOs in China because they say many of the business models of the companies are just completely unproven. Do you agree with that stance? And then do you think that China is going to replace Hong Kong as the premier IPO market?
Well, they're too. I think in terms of China's business model, I think the thing to step back and realize is there's still in early stages of development. There's, you know, even if growth comes down to 7.9%, I mean, Europeans would scream for that growth, okay? So there's a lot of growth.
And Americans.
Yes, nearly everywhere.
I don't know if I agree.
So I think there is still a lot of, you know, growth potential there. The risk is that we have a year or two of a setback. And that's something which Nomura has been looking at, you know, pretty closely.
But do you think the Chinese, you know, the government, of course, the Chinese central government has said that they need 8% growth for, what, 1.3 billion people, and most of the new grads get jobs. Do you think they're ever going to let growth come down below 8%, say, in the next few years?
Next year, I don't think so. So that's what well, 8% maybe. We've drawn the sand in the line at around 7.
Right. They say 7, but, you know, most economists say really, realistically, they're going to try to get that growth rate above 8%.
Yeah,
so you're predicting just slightly below the 8% target, which they've been talking about for 2 decades.
Yes, but which we think they'll be more comfortable with, because they've realised that in 08-09, the very aggressive stimulus led to bigger imbalances and problems for China further down the track. So they're sort of wary of doing that again. And the other thing to be aware of, because of the demographics, potential growth, the potential output growth is slowing. So China can't tolerate 10% growth like it did 5 years ago. It's got to get used to a bit of a slower speed.
When did those demographic things start to kick in and start to actually hurt the economy?
Well, it doesn't suddenly happen just at any point, but the working age population will start to probably decline around 2015.
Meaning age?
Working age, yeah.
Working
People
age,
who are working, 15 to 64-year-olds.
Right, and then they have to replenish that with the one-child policy.
Yeah.
Right.
That takes time.
Well, given what's going on with the EU banks, there's a lot of pressure for them to sell their core assets, the so-called crown jewels. There's talks that Deutsche Bank may actually sell their asset management unit. I'm wondering, what is the opportunity for China to come in and swoop in and maybe buy some of these assets that are being divested from some of these European banks?
Well, I mean, China and Asia generally, I would say, you know, we're surplus capital nations. Nearly all of us have current account surpluses. Most of the economies in Asia are in pretty good shape. So, you know, I think if things continue to unravel in Europe, there is going to be more and more opportunities for China to and other Asian countries to really step up outward FDI.
What about the impact of the banking crisis? We're hearing, you know, Commerzbank words, I won't say any more than that, but words. Dexter obviously is in trouble. Other banks around the region are in trouble. Liquidity crunch, we've seen the Lehman's crisis, of course, and how lending just completely ceases up. I mean, is that, looking into next year, is that your major concern in Nomura?
Absolutely. So we're forecasting...
Including for China?
We're calling it the Asia yo-yo, and we're expecting a yo-yo. We're expecting,
as opposed to the year of the dragon.
So we're either going to get a small V, the yo-yo goes down and then comes back up, and the coming back up is because commodity prices come off, policies get eased in Asia. It's either going to be a small V, or if there is a full-blown banking crisis in Europe, it could be a big V. We get hit a lot harder, but we will come back stronger. But we're still in the first part of that V going down.
Yeah, sounds more like a bungee jump, actually.
I mean, you have to remember, European banks' claims on Asia are about $1 trillion, more than double US banks. So if European banks get in a lot of trouble, as you sort of mentioned, there could be a lot of pulling back.
What do you feel in Europe? Do you think they are in serious trouble? I mean, clearly the exposure to, we don't know who is exposed to what, but the exposure of the German banks, the French banks, to Italy, Greece, etc., even the US banks. I mean, is it going to be like Lehman? Worse than Lehman? Lehman was a shock. This is just a slow car crash.
Yeah. I think we need to see a much more substantial policy response than we saw last week to avoid a meltdown in Europe.
You mean buying bonds?
By the European policymakers, probably most likely involving the ECB.
Rob, what are you most concerned of when you look at 2012?
Most concerned? I would say China slowing more abruptly. I think the European situation is very well known. It's been there. I think the risk is really China slowing more abruptly. And what fascinates us at Nomura is just how much Asia is now exposed to China. That has grown dramatically over the last 5 years.
All right, Rob. Well, in that case, I will still say a happy New Year to you.
Note,
2012 and Merry Christmas. Thanks for dropping by. That's Rob Subbaraman of Nomura.